Good morning, everyone. Hope you guys are having a fantastic Saturday. It is great to see you again, and I'm so honored that you're spending part of your morning with us over here at Elevate Equity and on the Saturday stream. Today, we have a very important topic to talk about, especially for those of you out there who are looking to start investing with their self-directed IRA accounts or any type of investment account that's in a retirement or tax-advantaged way. Because today, we're going to be talking about something that's very important when it comes to investing and evaluating your returns, and that is called the UBIT tax. And it might be something that you're thinking about. You're like, I thought that the whole point of investing in a retirement account is that it's already tax advantaged. That is true. However, in the normal sense of the word tax advantaged, there are IRS codes that apply to certain types of income that come in from into your retirement account that are exempt from paying taxes again. Okay. So what we're going to do is we're going to explain what those sources are, and then we're going to talk about how this specifically applies to real estate investing, although it can be applied to some other asset types and asset classes. And then we're going to talk about how to avoid this. What are the things that we can do to try to get ourselves away from paying some of this unneeded UBIT tax? Okay. So first thing is, unrelated business income tax generally falls that there's five sources of main income, or actually, there's five sources of income that can come into an IRA account that is exempt from paying taxes. Okay. And the first is real estate rental income. That's exempt. So if you have income coming into your account, it's exempt. If you have interest income coming into your account, like if you're writing notes or if you're paying, some sort of flat rate or getting paid a flat rate out, borrowing out your cash funds to someone else, that interest income coming in on top of the repayment isn't taxable. Capital gains. So if you invest in something and then it gains in value and then you end up cashing that out and that's in your IRA account, you don't have to pay capital gains. And then dividend income. So if you have a C Corp or any kind of company that's paid corporate tax, that dividend income coming into you don't have to pay. Or if you have royalties. So if your income comes from any five of those, then you're in a good position. However, what UBIT is, and this is a really sneaky way, right? Let's say that you have $100,000 in your self-directed IRA account, and you're going to use that to invest in a $400,000 property, okay? When you invest in that $400,000 property and you put some debt in place, let's say that you're able to get somehow $300,000 of non-recourse debt on that alongside that $100,000, and you purchase a $400,000 property. That $300,000 that you had put into the investment that's not yours, that even though the title is held by your IRA or whatever is tax advantaged, that $300,000 isn't really yours. So you're going to have to pay taxes on the income that is associated with that $300,000. So if you're collecting in, I don't know, to make it simple, $10,000 a year of income off of your $400,000 outlay, then the 3/4 of that, because only 100 of it was your cash, and then the 300,000 of it is unrelated. It's something that is leveraged, and so that money wasn't really yours. So the income associated with that, 3/4 of the 10,000 coming in, you're going to have to pay taxes on. And so that's something that obviously we as investors don't like doing. And to show you a little bit about how that actually works, now I'm going to go ahead and share my screen so you guys can see exactly what I'm looking at here. So check this out. When you calculate your UBIT taxes, and it's for the financed portion of whatever investments you're in. And for those of you who are investing in syndications or multifamily property that other people are offering, and it's your own cash offerings, be aware that most likely, even though you're not in control, right? You're saying, here's $100,000, mister, take my self-directed account and go get me some returns. When you do that, the syndicator, the investor, is going to take your $100,000 and they're going to put leverage on it, because that's the way that it works. That's the way that they're gonna pull your money up with everyone else, and your money is gonna stack up alongside of them, and they're gonna leverage that money out. So all of the income that you get into your self-directed IRA account, that portion of the income that comes in that's been leveraged, you're going to have to pay taxes on. And it can be pretty significant, actually, because if you look at it here, whatever the income is, you're going to have to pay up to 37%. So it kind of scales up. So as soon as you get up to about $13,000 a year for 2020, you're going to have to pay 3129 at least, and then plus 37% over on top of that. So you're looking at losing about a third to about a third, maybe even a little bit more of your income coming in. You're gonna have to pay that in actual taxes on your tax advantaged account. So that's something to think about. And remember, on your tax advantaged account, you cannot use depreciation. So you can't use depreciation to offset that. So that's something that you really need to be aware of. And then, of course, this is a really boring 990T form that you're going to have to submit. And so if you don't do this, then the IRS can come after you. Okay. So that's what unrelated business income tax is. And I just wanted to make sure that you guys are aware of what that looked like. Now, there are ways to avoid doing this, okay? And some of the best ways to avoid it include of things that you probably have never even heard before, okay? Some of the things that you can do, it's called a QRP, or a qualified retirement plan, or you can do what's called a solo 401k. Either way, in either event, what you're becoming is, instead of having a custodian, a separate custodian that you send direction to say, hey, do this with my funds, like you move your money into a self-directed IRA account, you ask them, you direct them to buy gold for you or to buy real estate or everything. You're the boss, but they hold title, right? Instead, and they actually run all the paperwork. So they file everything that needs to be filed with the IRS. They're your custodian. They take care of all that for you, and you pay them a fee to do that. When you do a solo 401k or something called a qualified retirement plan, unusually enough, you become your own administrator. So the startup paperwork for that costs a little bit, and you also have to pay a little bit of ongoing fees as well to either whatever platform you're using. I think there's some ongoing tax fees that you're going to have to pay in order to keep your own qualified retirement plan up and running. But as soon as you have that, for some reason, all of the limits of how much you can contribute to a 401k or an IRA, they disappear. You start being able to get a lot more limits. So you can bring more money into your retirement accounts if you want to. And you get to be your own administrator. So you're going to have to be the one writing checks. You're going to have to be the one making sure the accounting is right and filing all the tax paperwork. And so you become your own administrator. Okay. And so that is one way to kind of escape that. On the other hand, what you can do too is you can always try to just limit or eliminate your leverage in self-directed IRAs. So if you decide that this is not right for you, the other route that you can go down is you can just say, all right, well then whatever I invest in, I'm probably just not going to put any leverage on it. I'll just, lend it out, or I'll make sure that I follow each of the 5 ways that are exempt income coming in, which is the rental income, interest income, capital gains, dividends, or royalties. Okay, that's one thing that you can do. And so I just wanted to make sure that was out there. So what we should do now is, let me go back to screen share, and I want to really quickly give you a comparison. Okay, so here's a comparison of what an IRA, a self-directed IRA, can do, and what a QRP, or a qualified retirement plan, can do. And this information I got from someone in GoBundance. His name is Damian Lupo, and he runs a company that's called EQRP. And they help you set all of this stuff up. And so I can connect you with him if you are interested in learning more about how to get this set up for yourself. But in general, you can see here, there are some fees that you have to set up. There will be like a setup fee for the EQRP, a one-time thing once you become your own administrator, and then there'll be annual fees as well. So, but there's a lot more flexibility that you have when you work with a QRP. It is a little bit more of a headache, more time intensive, but you have more options. And so you can kind of see here, the max contributions from last year for an IRA and self-directed IRA is only $6,000. That is not nearly enough for what most people need in order to survive in their retirement. So here in a QRP, the limits are much, much higher. You have a lot more investment options, and you're able to borrow. That's the big thing that I wanted to let you know too. If you are allowed, if you're going to invest in an apartment syndication, or if you're going to buy property with retirement funds, you can use a qualified retirement plan and place leverage on the property. And for some reason, the IRS allows you to do that. So it's like its own separate account for your retirement, but they allow you more flexibility and the ability to borrow money against it and not pay those really, really hefty 37% UBIT taxes that will become due. Okay, so that is what you can do with the QRP versus the SDIRA versus the IRAs. And that's all that I really wanted to present to you. So if you guys found this content informational and you liked it, please let me know. If you found that it was cumbersome and not really useful at all, I also want to know that too. So wherever you're watching this, please like, subscribe it, engage with us. I want to figure out more about how I'm doing here. And if you have any questions at all, please reach out to me. We're here. Go to elevateequity.org and we'll make sure that you get your questions answered and we set and achieve all of your real estate and investing goals. So for today on Saturday, this is Derek Clifford. I'm signing off, and I'm going to go ahead and have a good rest of the weekend and hope you guys do as well. Take care, everyone.